Hi, I'm Tekoa De Silva with Sprott Global Resource Investments, and I'm sitting down here once again with Rick Rule, Chairman of Sprott U.S. Holdings. Rick, once again, good to see you.
Thanks, Tekoa. Good to be with you.
Yeah. So it's been a while since we've sat down for an updated market commentary, and I thought this could be a very interesting time. It's late 2015. We've seen a lot of volatility this year in the resource mining share market as well as the overall markets, the S&P 500 having experienced about a 10% correction in late August. And there are also some interesting developments occurring internally within the mining and resource space, and wanted to get your take on it. I suppose to start out with, where do you think we are in terms of the bottoming of this bear market, and how long do you see this continuing to, I guess, protract itself?
With regards to precious metals and precious metals equities, I'm going to go out on a limb and say I think we've bottomed. I'll probably be rewarded for that with another smackdown. But the truth is that it appears to me like the precious metals markets, in terms of both commodities and the equities markets that underlie them, are in recovery. My friend Steve Sugarrood says to make money you have to find a sector that's undervalued, that is despised, and that is in an uptrend. And if you look technically at the precious metals equities, they certainly qualify in all three categories. And we've seen in the juniors, after an absolutely brutal start to 2015, a true bifurcation where money is available to the best juniors and the share prices are recovering, in some cases by as much as 100%, in most cases by less than that. But you see the XAU up, you see all of the indexes up. But really the strong tone, I think, began in July, albeit from a beat up bottom. Now, with regards to industrial materials, base metals, coal, iron, my suspicion is that the bear market there, the overcapacity there, lasts longer, perhaps a lot longer. By a lot longer, I mean 2 years or 3 years. The truth is, as we've talked about before, there seems to be a lack of demand globally for everything. The extraordinarily poor quarter put in last quarter by Caterpillar would suggest that the world's demand for stuff is non-existent. And that doesn't portend well, of course, for copper demand, zinc demand, lead demand, iron demand, coal demand. Now, if you have a 5-year viewpoint, a 6-year viewpoint, a 7-year viewpoint, it's precisely at times where there is no hope in terms of the outlook for the sector that you buy the best names in the sector. So if you are a long-term investor in high-quality names, you can use this opportunity to buy the best of the best in base metals, companies like BHP, the best of the best in the oil business, companies like Exxon. But understand that you're going to be going through some fairly turbulent water for the next year and a half. In the oil and gas business in particular, and in the part of the oil and gas business that we inhabit, the sub-6, sub-$700 million market space, I think it has lower to go. Again, that doesn't mean that you don't take advantage of special binary exploration situations that aren't connected to the oil price. But the truth is that the issuers and the regulators are allowing the industry to, in effect, perpetrate securities fraud by using unrealistic price assumptions to set net present value guidelines for loan valuation parameters. That, I think, will last until next year's annual reports, because these companies, although they aren't getting their credit lines called this year, aren't being given any more money. They're producing out the reserves without adding any new reserves, and their loan bases are staying the same. I suspect we're going to see a world of hurt next year in the junior oil sector, which will be one of those once-in-a-decade opportunities to provide capital for the sector on terms that are very, very, very advantageous for the investors. So all in all, I'm fairly hopeful. I would say right now as we speak, October of 2015, the discussion pipeline that Sprott has in front of it, the people that we're talking to about financing their exploration or development opportunities, is as deep as it's ever been in terms both of number and in terms of quality. That isn't to suggest that we don't have competition in the space. One of the themes that we talked about the last time that you and I had a visit was the amount of real money, heavy money, deep money circling the sector. And that's starting to come home to roost. The recent Pretium financing, as an example, featured Blackstone, a huge, huge, huge private equity group, coming into a $500 million financing in the resource sector. And they were one of 4 competitors to finance Pretium. The idea that there isn't capital available in the sector is silly. There's lots of capital available for good deals. There aren't very many good deals. Another example of that, and it's something that you and I have talked about in interviews before, is the capital that's available for very large base metals mining companies, despite the gloomy outlook for their commodities, by selling the byproduct precious metal streams. This is a really unique opportunity that people need to pay attention to. The truth is that precious metals cash flow, structured as a stream, trades for sort of 15 times cash flow. That same cash flow in a base metals company valued at base metals multiple is about 6 or 7 times EBITDA. So a company that needs cash, a big base metals company, can sell a stream to somebody like Franco-Nevada or Silver Wheaton at 10 times the EBITDA and simultaneously lower their cost of capital while they're being accretive to the streamer. There are $15 or $20 billion worth of these transactions that can take place in the next year and a half, and I suspect they will. They will benefit the investor, they will benefit the streamer, and they'll benefit the base metals companies. This is just an example of one of the opportunities that's available in market chaos, because during market chaos, people don't look for opportunities. They look for excuses to justify their fears.
Mm-hmm. Yeah, Rick, I'm glad you mentioned that royalty opportunity with base metal producers, because it was about I think about a year ago now that we put together a commentary in which you noted that to be about a $20 billion opportunity to pull out those byproduct precious metal streams from the base metal producers. And it struck me that it seemed kind of like buying an orange, let's say for 60 cents in Florida, driving up to New York and selling it for $1.20. You can afford to overpay by paying 80 cents down in Florida because you can turn it around and sell for $1.20 in New York.
And that's a wonderful image that you've just presented. You described the arbitrage very, very well. The market is willing to pay a premium for long-term precious metals streams because the market has a better outlook for precious metals prices than the market has for base metals prices. The market is particularly willing to pay for high-quality streams, and large base metals mines often have 20 or 25-year mine lives. So there's a lot of certainty to the amount of metal that will come out of the stream. And the final thing is these very big deposits almost always surprise you, and they almost always surprise you to the upstream, to the upside, which means that a company that's buying a stream on what appears to be 3 million ounces of gold is very often buying a stream in what turns out to be 3.6 or 3.8 million ounces of gold, because the exploration surprises on very large, high-quality deposits is invariably pleasant.
Rick, I want to ask you a little bit about how you're managing client portfolios here. And before doing so, I want to ask about the waters, if you will, of the general equity market. We saw the S&P 500 come off about 10%, and I understand that you're more of a credit analyst than you are an economist, but what are your thoughts there over the next 2 to 3 years? If we see something severe in the overall market, how is that going to impact metals and mining equities?
Well, the first thing that'll happen if we see something really severe in terms of a contraction in the stock market is people need to understand that natural resource stocks are stocks, and they will react negatively. It's my point of view that the natural resource stocks have already had their bear market. So while they will decline, that decline won't be as steep as it will be for the general market securities, and the recovery will be quicker. History's on my side with regards to that observation. The truth is that in the very short term, the market's a voting machine. And it's only in the long term that it's a weighing machine, which means in the short term, the market measures people's emotions. But in the long term, markets measure value. And the truth is that the natural resource markets are in a deep cyclical bear market, which means that they're already cheap. I don't believe that the same can be said for the general market. And so my suspicion is that value will win out in the case of a decline in resource equities that's linked to a major market decline. But make no mistake, if we see a major liquidity squeeze and we see a a downside in the market similar to what we saw in 2008. Initially, the resource stocks will go off with all the others because the sell decisions often aren't made by the investors. They're made by the margin clerks. And the margin clerks sell what they can, not what they want to.
Well, Rick, where do you see resources fitting today in terms of a person's portfolio in the context of looking at the broad market as a whole?
That's the $64 billion question, Tekoa. The truth is that after a 4-year bear market or a 2-year bear market in oil, investor expectations with regards to natural resources are very low, which means the proportion of investors' portfolios devoted to natural resources are very low, which means that the room for recovery is very high. We've done some internal preliminary work at Sprott talking about the resource allocation in generalist mutual funds, now as compared to over time. In Canada, over time, the median and the mean apparently is in the mid-teens, meaning the generalist mutual funds in Canada generally have between sort of 15 and 20% of their allocations to natural resources. And right now, as we understand it, they're at about 4.5%. A similar statistic, and I think it came from Morgan Stanley, I can't remember exactly, has to do with precious metals and precious metals equities. The high point in concentration in precious metals and precious metals equities occurred between 1980 and 1981, the top of that great super cycle in precious metals, where about 8% of investable assets in the United States were in precious metals or precious metals equity. The same measurement today is 1/3 of 1%. The median and the mean over the last 3 decades is between 1.5% and 2%. So in order for precious metals and precious metals equities allocations to get to the 3-decade mean, they would have to go up 6-fold as a percentage of the total investable assets in the United States. There's an awful lot of room to the upside. Now that doesn't necessarily, it isn't necessarily true with regards to our own client base, who are much more natural resource centric. But the truth is, even in our client base, particularly the more speculative parts of our client base, the disintermediation, the move away from natural resources to other speculative sectors like technology has been extraordinary. I've seen this 4 times before in my career. And these periods of deep despair are the necessary component, the necessary factor to turn a bear market into a bull market. The expectation is so low now that you can't help but to exceed it. And markets move up when you exceed expectation.
Rick, in winding down, is there anything that you think we may have missed?
I don't think so. I think with regards to investors that they need to ask themselves some questions about where they fit on the risk-reward spectrum. This is, in natural resources, a wonderful time to be a value investor in large cap natural resource stocks. It's also a wonderful time to be a speculator. But if you're a speculator, you have to understand the risks and you have to understand the volatility. In speculation, you become your own largest risk. Myself, all of the money I invest prudently now, I made by speculation. And I'm moving into the part of the cycle where I'm going to become much more aggressive in terms of speculation. That's a consequence of the fact that I have the psychological and the financial ability to stand the risk. And our clients need to ask themselves whether they have those 2 capacities themselves. If the answer is yes, and I know I sound like a broken record on this, Tekoa, the best way to do it, normally if you can afford the risk, is to build yourself a private placement portfolio and build in the warrants of a recovering market and the possibility of a recovery, the possibility of success with warrants. But for customers who don't have the financial wherewithal or the psychological wherewithal to withstand both the risk and the volatility inherent in speculation, look towards the very, very, very high quality seniors. And we could, of course, help in that process.
What's the best way that a person could participate and have that conversation with us?
Well, I would suggest, of course, that they contact their global broker. For those people who are listening to this who haven't got around to having a Sprott Global Broker, they should address that. It's easy to come to our website, and I suspect the right address would be contacts@sprottglobal.com. and make arrangements to interview a Sprott Global broker. Another thing that everybody who's listening to us that doesn't have a relationship with us should do is they should subscribe to the Sprott's Thoughts blog, which is very easy to do on the cover page of our website.
Rick Rule, Chairman of Sprott U.S. Holdings, thanks for sharing your comments with us.
Always a pleasure, Tekoa. Thank you for facilitating the opportunity.